The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen, and welcome to a Standard Bank webinar hosted by Standard Bank Financial Consultancy. My name is Ketio Gunene. I'm the coordinator of the webinar, but don't worry, the invitation is not incorrect. Errol Mayer will be presenting our session today. Just to remind you, we are talking the budget speech, the main topic on everyone's mouth nationally. We're looking at highlights today and how it affects your financial planning. Now, a lot of you will know who Errol Mayer is, but just to remind a few of you who the esteemed Errol Mayer is, he's a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He has written many tax and financial planning related articles, newsletters, study materials for universities and academic journals. He has even authored a book called Notes on Estate and Financial Plans, which is now recommended study material for many universities. He has worked as a tax advocate for SARS, impressive, and as a legal advisor for corporates. Errol was a renowned lecturer, examiner, and moderator for various universities for many years in South Africa. But lucky for us, Errol currently holds the position of Head Advisory Propositions at Standard Bank. Now you realize and see why we have chosen him to take over our presentation today. But before I greet Errol and hand over to him, I just want to do some housekeeping, make sure everybody is hearing me there and I'm not talking to myself. I would like for you guys to look on your screen. There's a pane on the right-hand side of the panel. There's a small high five. It's like a small hand. If you don't mind just clicking that hand for me, this will assure me that you can hear me and I'm not talking to myself. If everybody can just click that, thank you. I see a hand come up. Thank you, Zola. Thank you, Zaika. Thank you, Wasani. Thank you, Wendy. Thank you, Trevor, Tony. Okay, there's a few hands going up. So I'm not talking to myself. Great news. Second on our housekeeping list, guys, is questions. Ladies and gentlemen, if you have any questions during the presentation, I will not disturb Errol. I'll allow him to continue and finish. What you will need to do is you'll see there's a small questions panel there as well on your panel on your right-hand side. Type in your question for Errol. At the end of the presentation, I will then ask Errol the question and he will give you the answer. Okay, I hope that is clear. I hope you're comfortable and you're ready because I'm about to hand over to Errol and he's going to start our discussion for today. Good afternoon, Errol, and welcome. Thank you so much for taking the time to sit here and discuss the budget speech highlights with us.
Well, thank you very much. Well, budget speech, question, was it a good budget speech or was it a terrible one? Well, that depends from the point of view that you're viewing at it. And as we unpack the budget speech today, remember we were looking at it from a financial planning perspective, and then we would be able to answer whether it was a good speech or not. Okay, so the topic then, as I said, is the highlight of the budget speech and how will it affect your financial planning. So what we're going to try and do is to see if we can unpack it and make it a little bit practical. I mean, everyone says we're going to pay higher taxes. The real issue is what is the impact of that? And then secondly, what are we going to do about it? And this is why we do financial planning. So I'm going to try and explain to you some strategies, what is available out there, and how one should actually go about. But let us start off with one of the fundamental aspects of financial planning, and that is abiding by the principle which you see on your screen. And I read, planning is bringing the future into the present so that you can do something about it now. And this is what financial planning is all about. We often talk about goal-based financial planning, and a different way of putting it is by stating, let's look at it from the end in mind and work backwards. Now, in succession planning, we also do the same, and we use the same principle. So we often tell clients and say, if you would fast forward a couple of years in the future, and if you would sit around the same table and say, what is there that I could have done differently, decide on that, and then go back to the present moment and go and do that. So this is what financial planning, this is what succession planning, and this is what estate planning is all about. Now, I need to position this because when we look at the budget speech, we must have a look at the impact of these changes on our long-term goals. So, what is my approach to the matter? I think the answer lies in the simplicity of the solution and, very important, a solid understanding adhering to financial planning principles. So let's start off then with the framework for wealth creation or financial planning. Because remember, it's one thing to talk about and say, oh, we're going to pay more taxes. What is the impact of that? And do I have a plan in place? So let's quickly just set the scene and look at what financial planning is all about. Now on the screen there, you can see 4 quadrants. I often refer to this as your balance sheet. And it comes as no surprise that Pravin Gordhan, it was stated that he's got a tough balancing act. Minister Pravin Gordhan's budget speech is very similar to what we do. We only do it on a much smaller scale. He also had to balance the assets and the liabilities of this country. So let's look at it from a financial planning perspective. So there you have 4 quadrants. On the left-hand side, if you can see my cursor, that would be regarded as an asset as well as save and invest. Now there are only 2 ways that you can go about to build wealth. In the first quadrant, what you will find is that you may be earning a salary, or you may be receiving business income, and from that you would generate an income. Tax plays a very important role because it reduces that income of yours. Then on the other side on the same side of the balance sheet, on the left-hand side at the bottom, you will see that would be capital savings that provide a passive income. Now these assets must be balanced with your liabilities. And on the right-hand side would be your liabilities. And these liabilities from a financial planning perspective would be, I want to use the fruits of my labor and I want to live and enjoy. That would mean I want to stay in a nice house, I want a car, future holiday, perhaps the education of my kids. And then the remainder, depending on your belief system, would be to leave something for your children, or some people say no, I will provide for education, and that is the legacy. So these assets and liabilities, we must continuously match that, and that is what financial planners do. So when we look at the budget speech today, you will see it will have an impact on the liability side, because the question is, if I'm going to pay so much tax, will I be able to afford certain things? And this is where financial planning comes in. I must look at my existing investments. What type of investments do I have to achieve and to balance these liabilities, with other words, to be able to retire, to buy that car or that future holiday. Now, I would like you to keep that framework in mind, because it's a lovely illustration to refer back and to ensure that one is on track. So let us then have a look at the budget speech and say, what is it that really has changed and is going to have an impact on me? Now, one must also look at what was not said in the budget speech and take that into consideration. One must also look at what if scenarios, if certain things would happen in future, because some of them are quite predictable based on what happened now. So what I've done from a financial planning perspective, I highlighted all these areas that I regard as important, and then I'm going to demonstrate to you how we can utilize and what the impact of that would be, but also how to utilize that it fits into our framework of financial planning. Okay, so let's go through them. You'll note that the ones in the red Those are the ones that change, and the ones in blue, the ones that stay the same. So I'll just talk around some of these pointers, and then I'll move on to some more detailed application and solutions. There's the first one. That was perhaps not a shocker, but that is perhaps the big news. The marginal income tax rate increased to 45% for people earning 1.5 million and above. And that made headline news. So many people, when they see that, it becomes an emotional issue, and they say, but I'm going to pay so much more tax. How am I going to be able to retire? How am I going to be able to afford education? And this is where financial planning comes in. It says, you know what? Let's first have a look at the impact. Maybe it is not that bad. Go and do those calculations. And after we've done that, let's have a look at our goals. Can we still achieve it? And what is the best way to do so? And you will find that in the budget speech, some relief were given in order for us to do this. So from a financial planning perspective, I think there's plenty we can make out of this budget. Okay, so I'll give you an example just now of an income tax calculation and some solutions. The second one, the company tax rate remains at 28%. Well, it was very difficult to touch on that one because once you start taxing companies, then you are taxing productivity. And the same applies to VAT. VAT is quite an emotional issue, and it would be pretty unfair to tax the poor, which in the current economic circumstances finds it very difficult. So company tax rate was not changed, but what has happened is that dividends tax increased from 15% to 20%. Now dividends tax, it is the profits of a company that is distributed after salaries and expenses are paid. And those dividends will be taxed locally and a withholding tax of 15%, but that is going to be increased to 20%. And what is the effect of that? And one must also look, why is it that it was done? And I can tell you now, it was not a money spinner. This was all about ensuring that the tax loophole could not be opened up. So later on, we'll have a better look at that. Okay, then interest exemptions remain the same. So if you've got funds in the money market, up to 23,800, if you're under 65, you will not pay any tax. And for people over 65, the amount is 34,500. Now, some people may ask, why did it not increase? Well, here, let me tell you something. It will never increase. The intention was, a couple of years ago, that should be abolished when they introduced the tax-free savings. But because of difficulties, people said, you know what, people have contracts with the banks, year contracts, etc. So therefore, they would be penalized. And then, customary, what Treasury always do, they would say, okay, we will leave it there, but we will never ever increase it. So every year, apart from inflation, it will be there, and don't expect that ever to increase. But while it's there, it is a value add, and at least taking inflation into account for at least the following 10 years. Right, the rebates increased as well as the tax threshold. So when we do the tax calculation, I'll show you the relevance of that. Those rebates they're talking about, technically they should be saying credits, just like you get medical credits. A rebate is nothing else than an age credit. So if you're under the age of 65 and under the age of 75, depending on your age, you would receive an additional credit. And that was increased a little bit, which is customary for Treasury to do. Medical credits increased purely because of inflation. But over these years, the last couple of years, the value of that is actually dwindling away to some extent. But what's very important, when it comes to retirement, there are some tax advantages after the age of 65 for medical credits. So financial planning becomes very important after the age of 65. And I'll tell you why. Because a salaried person will have very few tax breaks. There's very little he can do to reduce his taxable income. There are only three avenues. The one is a retirement annuity, which we're going to discuss. The other one is making use of tax-free investments, and then also to make sure that you optimize on all the medical tax relief that you can get. And there's some room for planning still currently, especially for over the age of 65. The next one is the tax-free investments, increased from 30,000 per annum to 33,000. Well, those investments, one must ensure that when you use it, it must be for a medium to a long term to be really, really effective. Of course, 30,000 per annum is really not a lot. But the point is, if you snooze, you lose. So what we have to do is we have to look at financial planning and that framework and say, where can we fit this one in that we can optimize on the benefits? And I will discuss that later on as well. Then the taxation of retirement funds remained the same, but let me remind you, from the 1st of March 2016, there are huge tax advantages with retirement annuities. And the government has been extremely generous with these tax breaks. So there is a possible solution that I would like to investigate. Perhaps now I often refer to the retirement annuity as one of the best disciplines ever invented to solve so many problems in financial planning, and I will highlight some of them for you. Then the tax deductible contributions to retirement funds, as I said, it remained the same, but still very generous. The funds itself also not paying any tax. Now, let's move on to the capital gains tax and estate duty. It's often known as wealth taxes, but not quite true. Estate duty and transfer duty would be a wealth tax, and the Davis Tax Committee would tell you that. But capital gains tax is one that slips through and no one notices it. And I've read now with the budget speech, some people saying that capital gains tax rate was not increased, and that is not true. And it has a huge impact and something to be monitored. As a matter of fact, from an estate planning point of view, capital gains tax is the one to watch. And I'll explain a little bit more later about that. The CGT exclusion rate on death remained the same. That's 300,000. Nothing increased. The Davis Tax Committee perhaps next year may have some good news for us in that regard. The estate duty rate remained the same, so nothing happened this year about the Davis Tax Committee's recommendations about the estate duty. And we will, in all likelihood, see that happening next year. That's why I say this budget, it was a taxing of the wealth, there's no doubt about it, but it was a taxing of the wealth on the income side. That is on income tax. I have no doubt that next year budget speech, we will see the tax on the capital coming through when they implement the Davis tax recommendations, if they do so. And it seems that they are prepared to actually do so, and it was mentioned in the budget speech. So I'll talk about that a little bit later, because taxing the wealth and how do we go about it is definitely going to be a topic that is going to be discussed the following 2 to 3 years. Then the Davis Tax Committee, none of these recommendations were incorporated, but the one on trust, which was a recommendation already in this year's legislation, effective from the 1 of March 2017, is already kicking in. So it's very relevant for planning purposes. And that was a product and a result of the Davis Tax Committee. So therefore, because the personal income tax rate went up for trust from 41% to 45%, trust will follow suit, and therefore the tax rate in trust would be 45%. Now, the tax rate for trust, 45%, is perhaps not too bad for many taxpayers because you can still distribute the income. The real issue comes in when one looks at the capital gains tax that the trust will pay in future, which could make it not a popular tool. So we will discuss that one later on. And then the transfer duty rate decreased. Well, not much to be said. Thank you very much. But when you look at the 10 million house, I think the savings are about 4,500. So really, that's nothing that is exciting. So there it is. There in a nutshell, I tried to prepare you on the changes and the impact that that will have on financial planning. So the changes as well as what was not said remains extremely important. For example, the inclusion rate for capital gains tax may not be increased, but because the marginal rate increased to 45%, it effectively increased capital gains tax overnight for the individual from 16.4% to 18%. That's quite a jump, and I don't see a lot of reports on that in the press at the moment. So what is our strategy then? Let's go back to financial planning. Having regard to this budget speech and the things that I've highlighted, which financial planning strategies do I employ to assist us in making good choices? Well, let's quickly have a look. What is it that Minister Pravin Gordhan did? There you see, he's also matching the assets and liabilities. His assets would simply be to generate income through various taxes, which could be VAT, corporate income tax, sin taxes, fuel levies, etc. That is the salary, just like in our personal budget of the government. Then there is also capital investments that can secure an income. Now the fact is, because of the liability side, the expenses are high. To match it becomes extremely difficult. And that's why Minister Pravin Gordhan had a very, very difficult task to actually balance this budget of South Africa. So as the individual would have on a smaller scale, future liabilities such as education, such as retirement, such as a future holiday, or maybe after 65 to start a second career, turn a hobby into something that can move on to the asset side of the balance sheet and can produce an income so that I can match those liabilities. So Minister Pravin Gordhan was doing exactly the same what we are doing. So what he's done, we now have to dwindle it down and do it on a micro level. So let's start off with the applications and let's start talking about the income tax, the 45% one. So there you see, I took this from the budget speech itself. So there you will see income tax on the left-hand side would be the 2016, follow my cursor, the 2016, 2017 tax rates, and these are the taxes that you'll be paying this year. So you'll see that you start paying tax after the amount of 188,000 and you will be paying tax 18% on the first rand after that. And that is simply how they got hold and calculating the threshold. You will find if you take that primary rebate, which I call a credit, you divide it by the inclusion rate of 0.18, you will get that. And that's how they calculate the threshold. With other words, your credit is similar, it's the same that your income, and therefore you will not pay any tax, hence the meaning of threshold. Now, the band stopped at 700,000 and you would pay 41% after that. But one must, when you do the calculation, and which I'll do just now, you see that the effective rate is usually much lower. It doesn't mean that you pay 41%. It is in totality what is the effective rate, and that is the one that we should be concerned about. Now, there are the rebates that we're entitled to currently, and then on the right-hand side, you will see the position 2018, and there are the rebates or the credits, as I call that, comparing to currently. So you'll see there was a slight improvement, although very little. Now, if we would look at the changes in a nutshell from 2017 to 2018, we've heard the minister said, well, they adjusted it by only 1%. Now, what does that mean? It means that amount there, the 33,840, if you multiply that by 1.10, you will actually get that. So that 1% is way beneath inflation. And therefore, effectively, we are becoming slightly poorer. It did not keep pace with inflation. And for that reason, we are paying more tax. But when you do the calculations, you will find that it may be a little bit less, as a matter of fact. But then we didn't take inflation into account. So what was the big shocker then? they introduced this new band, and they said, well, if you earn your taxable income, that's after deductions, if that is 1.5 million, then we'll apply, that would be the amount payable, and over and above that, you'll pay 45%. And I can tell you now, when you calculate the tax on 1.5 million, you're going to pay actually 41% and not 45%. It's only when you start getting to the salaries of 2 million and 2.5 million. So it's a very few selected group of people that is actually going to be hit by these additional taxes. So up to 1.5 really, and I'll do the calculations, very little has changed. So this is where we are now, and this is what all the wah-wah is all about. Now, let's go and do the actual calculations as I said earlier. Before one start getting all excited and say, you know what, these taxes, blah, 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 blah. Perhaps the best is, I always say that, you know, if someone is going to say, I'm going to hit you, then you shouldn't beg not to be hit. What you should say is, well, hard, and where are you going to hit me? And we follow the same strategy. Let's go and do those calculations and see where do we stand. So I took two examples. The first one is 600,000. On the left-hand side here is 2017, and there I did the calculation. I say if your gross income is 600,000, there are no deductions, no retirement fund, and on 600,000, that will be the band rate. That would be the marginal rate, which would be around about 39%. That would be the tax payable. That was the rebate. So your tax paid was 153,000. So what we have to do is do the same calculation with the new tax rate. And there we go. So I do it for the 2018. There is a gross income, follow the same process, and the band rate has shifted up a little bit, but the marginal rate, it is slightly less. So at the end of the day, including the rebates, I'm ending up with slightly less tax than what I've paid in 2017. But just remember that inflation also has an impact. So we didn't actually adjust for inflation fully. And that's what it's all about. Now, let's have a look if one would affect a retirement annuity, which I'm going to talk about. Now, I want to remind you, I said your point of departure is not the tax you are paying, is what do you want? So let's say one of your goals, the liability side of your balance sheet, is I want to be able to retire. Well, you've got to save for that. So what do? If we would affect the retirement annuity, which already said there are huge tax breaks, then effectively one can negate to a large extent the tax increase that took place. And that is the solution, because ultimately you do want to retire. So therefore, in that particular instance, to make use of a retirement annuity to achieve that goal, in this instance, he can contribute up to 165,000, which will reduce his taxable income, which will reduce his taxes, tax payable to 106,000, and the tax due would be 92,000. So it's going to cost you 165,000, but remember, you are not paying that to the government or anyone else. You are paying yourself because it's going to come back to you in the form of a retirement. Hence, making use of a retirement annuity, you are deferring and postponing tax to a later stage and still in order to achieve your goals. So let's have a look then at the scenario. Now that you understand the calculations, have a look at a scenario of 1.5 million. So in 2017, if I do the same tax calculation, you'll see the tax due is 520. Now this is not 1.5 million. Remember the expectation, we've got to pay 45% now. So let's do the calculation for 2018. So when I apply the tables, it is actually very similar, 520 to 519. So very little has actually changed. It's not that huge. But let us look and explore that retirement annuity. Now in this particular instance, this person can claim 27.5% of that gross income, which is his remuneration, which is huge. But it's capped to 350,000, so you may not claim more although you may contribute more, you may only claim 350. And the Davis Tax Committee did say maybe we should revise that upwards. Well, maybe next year. But currently, very few people can actually afford that. But the point is, it is available. That would reduce your taxable income quite considerably. And when we apply the tax calculations, you'll see that the tax would drop for this person to 376,000 for about 500 Rand. So that is a tax saving of about 143,000. Now, one has to look at the cash flow. What is the actual cost of that? That means that this person has to fork out of his pocket 206,000, and at the end of the year, he gets that tax relief. So you get an investment of 350,000, which is costing you 200,000, with the obligation that one day in the retirement, where there are more than enough tax breaks, I will actually take those funds. This is the best tax planning for individual and personal financial planning. So effectively, the effective tax rate that I spoke about earlier for a person on 1.5 million is 35%. It's not 45. By making use of a retirement annuity, it drops down to 25%. Now, interesting calculation. What is that cost of that retirement annuity, or let's phrase it different? What is the cost of meeting that liability on the liability side of my balance sheet to be able to retire comfortably? The real cost is about 14% of my salary, and that is in norm what people must actually save in order to retire comfortably. That's just a rule of thumb over about 20, 25 years or so. So that is not unreasonable, and it's pretty much in line. So in a nutshell then, what am I saying? Well, if the tax rate went up, we've got generous tax breaks. If you employ that, it's all about reaching the goal and not about the tax saving. And surely this can be done with proper financial planning. Good. All right, so just to tell you about the formula, the calculation of the retirement fund deduction is 27.5% of the rate of remuneration, gross income or taxable income, but limited to 350,000, effective 1 March 2016, so it is available right now. What are the benefits? Well, now one must look. If I'm going to use a retirement fund vehicle, such as a retirement annuity, there are certain constraints. So I've just highlighted a couple of these benefits. First of all, the retirement fund contributions are tax deductible. Capital gains, now for the first time, may be used to increase the tax deduction. So if you would sell a unit trust, you can add that amount to get you to 27.5, which is not a bad idea, because technically you're converting the disposal of another asset in order to supplement or increase a retirement annuity. Build up in the fund is tax-free, no dividends tax. Tax breaks when you retire from the fund because you've got the 500,000 tax-free, and that may later years may increase. If you would contribute more, even that would qualify for exempt income. So if you would get an annuity after the retirement date, all those additional contributions will be set off against that annuity, so that annuity can effectively be tax-free. So none of those tax benefits will be lost. After 65, your income decreases, and then you have generous tax breaks, and some tax planning from a financial planning perspective can be done. It is also possible to choose the income that you want. A few comments about dividends tax. So why then, I asked, this dividend tax? And I said it was more for tax avoidance. Now, dividends tax, if you've got an equity share portfolio, 15% will be withheld, and now it would be 20. So that won't be too much if you have a share portfolio. But directors who are shareholders of companies, what they do is they would look at what point is it to their advantage to receive dividends instead of salary. So because the tax rates went up to 45%, one can imagine that they would allocate more to dividends, and therefore their effective rate would be very low, which is currently about 38%. It is for that reason that they had to increase the dividends tax, so that this gearing cannot ensure an unfair tax advantage to director shareholders. And that was mainly the reason for that. Tax-free investments. Well, the annual allowance, 30,000, it was increased to 33, and it may even in future keep pace with inflation. 500,000 maximum that you contribute stays the same, but if that fund would grow to 1.5 million, all of that would be tax-free. And that capital gains tax can make a significant difference by choosing a tax-free investment as opposed to choosing just a simple unit trust. So what is the rule? Optimize on the retirement annuity fund for retirement purposes, and then optimize on tax-free investments in order to achieve some of your other goals, such as education. So some people will have the question, what should I do? Tax-free investments or retirement fund? Where should one start? People would ask, which vehicle is most tax effective? And I say, this is not what one should do. Remember, planning is bringing the future into present so that you can do something about it now. So this is all about the retirement and not about the tax that you are saving now. So a tax comparison is actually unreal and contrary to solid financial planning principles. And it's going to be tough to calculate which one is better from a tax perspective. And we have done those calculations in the past and they all differ. But that is not the point. The question is, what is that you want? If you want medical pre-funding after the age of 65, that is the best investment to make use of. Because just like a retirement annuity, the build-up in the fund, there are no taxes. This dividend tax we talk about 20%, that is not going to be payable. There are no capital gains tax. And even when you would leave the fund or dispose of the asset, it will be exempt. So there will be no capital gains tax. The only tax would be estate duty, and we're expecting very generous allowances next year if the Davis Tax Committee's recommendations are implemented, which makes retirement annuities and tax-free investments absolute essential depending on the purpose of your financial plan. Future holidays, to start a new career, you'll note there I talk about retirement, refuse to accept that people must leave at the age of 65. Things have changed. I say no, you must put new tires on. So at 65, save for something. I've known of two examples. There was a Wits professor once came to me and he retired. So then what he did, he went to the bar. That's now the one that for advocates. And he went to the bar and within 2 years he was running a very successful practice. So I've met other people that took early retirement and all he does is chartering boats, taking people out, having a wonderful lifestyle. But that was his retirement plan that he did. And those type of things we'll see more and more in future. Right, so what am I saying? Your strategy should not be to save tax. Don't focus on the tax, but rather the most tax-effective way to reach my lifestyle goals. And that is where a retirement annuity and a tax-free investment is solid, tax-efficient planning vehicles. So there is our, to remind you, a balance sheet. Left-hand side to create the value. If you create and build, there's a little bit less because of tax. Make sure you make use of the tax breaks so that you can live and enjoy and meet those goals. As simple as that. But what was not said in this budget speech? What about wealth taxes? Estate duty and capital gains tax. Now I said capital gains tax is not a wealth tax, but surely it acts like one. I always say if it walks like a duck, it quacks like a duck, it must be a duck. So perhaps capital gains tax, theoretically, it's a tax on income, but currently it is being used because surely it's only wealthy people that pays capital gains tax. That is the one that we must monitor. So let's have a look at estate duty. Estate duty, the rate is 20%. The real relevance of that, do I have enough money left so that there is sufficient for my beneficiaries so that I can ensure that my spouse is looked after into her retirement? That is the purpose why you would try and not to pay additional estate duty or would do planning with trust, etc. The Davis Tax Committee recommended that the spouse's deduction, that's where you leave the assets to the spouse and you don't pay tax on that, be removed. Because technically it's not constitutional, which is a good argument. The point is, will we be worse off? Well, interesting thing. Your current abatement of 3.5 million, it's proposed to move it up to 15 million per taxpayer. So people with estates less than 30 million really won't have a estate duty problem. So that's going to change the playing field. Now currently there's no law, it's only recommendations by the Davis Tax Committee, but it did say in the budget speech that we will look at this one beginning of next year. So next year we may see the other form of wealth tax on capital, not on income as this year, may take place, which means that many people will have to revise their affairs and say, where do I stand, similarly to what I've done now. What about capital gains tax? As I said, capital gains tax actually increased for the individual from 16.4 to 18%. How do I get that? Well, a 40% inclusion rate stayed the same, but if you multiply that by 45, you are paying 18%. When we look at companies, the tax rate would be 28%, multiply 80% of that, which I think is about 22%, is the tax charge on that. When it comes to trust, it is 36%, and that is heavy. So, all fine and well, currently with a trust, you don't pay estate duty, but if you dispose of that asset, you're going to be hit with a rate of 36%, which is much higher than estate duty at the moment. And that's the one that people often don't see. And I've seen that in succession planning, people having assets, farms in a trust. They want the farms to dissolve upon his two sons, each in his own trust. You are going to pay 36%. So this is the era where trust will have to do his own estate and financial planning, mainly not because of estate duty, but because of capital gains tax. Also here, the Davis Tax Committee recommended to remove the spouse's rollover, with other words, capital gains tax not to be postponed. But then, instead of the 300,000 that was not adjusted this year, it would be 1 million. And that perhaps explains why there were no adjustments to the 300,000 capital gain exclusion rate. So, wealth taxes and death taxes, perhaps more correctly to state it as such, definitely next year's budget, and something that one must incorporate in your financial planning and see how it could have a possible impact, but I refer to as the what-if scenarios. So what then did change with trust at the moment? Well, here's a very simple rule. Trust was not under the attack. There was nothing said this year in the budget speech. Why? Because already with the Section 7 Cap C that they referred to, it was implemented and is already in legislation effective from the 1st of March 2016. So what they said, trust, there's nothing abnormal with a trust, although that was not the initial thinking. What is abnormal is a loan account. So if you would a loan account to your trust and you won't charge interest, some serious planning is necessary. So I thought, let me give you an example. So this would be the trigger. Do I have a loan account? I don't charge interest. You're going to have a donations tax liability. Let's say you have a trust, you have a loan account of 2 million and you don't charge interest on that. What they would do is say on an 8% rate, which is the official rate at the moment, we will assume that you received an income, which would be 160,000. We will give you the 100,000 donations tax exemption. So on the 16,000, we will tax you at 20%, the donations tax rate, and that gives you a tax of 16,000, I think, or 12,000, sorry, 12,000 Rand. So 12,000 Rand every year you'll pay. But there's a hidden danger here. We work on an 8% rate. If there would be a possible downgrade or charge a higher interest rate, in such an instance, then that donations tax is going to increase. So if we find ourselves in an environment where interest rates can increase, you better get rid of that loan account as soon as possible. Funny thing is, in order to get rid of the loan account, where the trust must repay it, you often have to dispose of an asset, which is going to trigger exactly that capital gains tax I'm talking about. And those are the things not being stated by the budget, but which has the impact because the trust rate is up to 45% and the capital gains tax rate increase. Some very careful planning the year ahead is necessary by people who have assets in trust. So then it was a popular loophole people looked for and says, you know what, if I make a loan to a company and the shares of the company are held in trust, then I avoid these anti-avoidance provisions, and they were quite correct. So very quickly, in the budget speech, it was not in the press as one of the annexures, there was a little clause, statement, and say, those people doing that, be very careful, we can introduce. So the time has come that one must look and steer away from these trying to beat the tax man, because it's eventually going to catch up with you, and CGT is only climbing. It's a good time to make decision and to have a future look at it. So then let me end off. What is the alternative to a trust then? And remember that retirement annuity I spoke about. This is it. Professor Matthew Lester often refers to this as the poor man's trust. So there I did a comparison. You'll have a trust on the left-hand side and the right-hand side, the retirement annuity. Remember, a pension fund is nothing else than a trust fund. It acts the same way. It does the same way. It protects the beneficiaries, which is the ultimate purpose of a trust. So when you look at a trust, you find the funding, the loan account, as I explained, is very negative. With the retirement annuities, as I explained, very positive. The purpose of the benefits, it's always for the benefit of the beneficiaries, and this is what a retirement fund and a pension fund is all about. Protection as creditors, one of some of the reasons why people would set up a trust. Well, you get exactly the same, but just governed by statute. You are protected. Asset allocation, well, in a retirement annuity, you can have a spread depending on the target of your investment strategy. The build-up in a trust, as I explained, from a capital gains point of view is very, very negative and becoming worse and worse. With the retirement annuity, is not so. So here we find two vehicles, and that's why I refer to retirement annuity as the best discipline ever for any medical condition in the financial world. You'll find that the retirement annuity does exactly the same. And here's the best of all. With the trust, the thinking is, I want to save on estate duty. Retirement annuity, by law, is exempt, and you don't pay estate duty. So the way people look at things, one can simplify things and still achieve the same instead of being tax-driven and just follow fundamental financial planning principles. Transfer duty, not a big deal, really not a big saving. Perhaps that little bit of saving can help people to put down a deposit, which those funds can not usually be accessed through a bond or a loan application. So very, very limited relief, but not much to write home about. So I end off with this. Remember, planning is bringing the future into the present, so you can do something about it now. Don't start with the tax and the higher tax. Look at what you want to achieve. Work backwards and say, which vehicles can I use? And you'll find those vehicles. It is available out there in order to reduce the tax and still to achieve what I want to achieve. I hope that made sense. So if there are any questions, then we can perhaps deal with those before we end off.
Thank you so much, Errol. This one we rectified. It was just the first. Okay. Khopotso, you said you couldn't hear. I hope you could hear eventually. You just need to just put up the volume normally on your laptop, and this will be recorded. Especially if you're a planner, you'll find this on the SPFC portal. Okay. Yes, the webinar had started, Khopotso. Thank you. Okay. Here's one question that I got, Errol. How do I legitimately reduce my personal income tax liability?
Oh, well, that relates to another question here. Can one reduce the marginal rate of 45% by contributing? Yes, you can. Just remember, when you say 45% marginal, I think you've got to earn about the 3-4 million before you're actually paying that as an effective rate. So the correct answer is you reduce your effective rate, as my example has pointed out. I reduced it from 35% on a 1.5 million salary to about 25%. So the answer is absolutely yes on that one.
Okay. And then the other question here, Errol, is, are trusts still a viable tax saving tool, since you were talking about trusts and using retirement instead?
Well, the answer is yes, but one has to be very careful. You're talking about a whole lot of taxes. The primary purpose of a trust is that the assets of a trust must be administered for the benefit of the beneficiaries. Since you've got a whole lot of beneficiaries, you've got lower tax rate. If you follow that principle, yes, you will save tax. But if what was so popular in South Africa, you do it purely for tax reasons and not for the real reason, then you'll find you're going to walk into a myriad of anti-avoidance provisions. So I think my whole webinar was about don't focus on the tax, focus on the goals, and tax benefits will flow. But yes, in some instances, it's still available. Let me give you an example. People who don't have loan accounts and they have estate build-up. By the way, people who own assets more than 100 million in this country, I've discovered, up to 2 billion, it's all in trust. And if there are no loan accounts, they absolutely save on all the estate duty. And I think government will do something about that in future with anti-avoidance provisions, although they are battling. So the answer is yes, but tread very, very carefully.
Okay. One from Robert Alexander asking about how does the 45% marginal rate compare with the UK, USA, Canada, Australia, and a lot of countries, and New Zealand?
I've got absolutely no idea, but the stats are available. I can't remember offhand.
Okay. Why was the company rate not increased in line with personal tax increase? And that's from Ian McGregor.
Taxes serve a different purpose. Income tax, it's a sliding scale that it's taxed according to how much you earn. So with other words, the privilege in this country and what you get, the more you earn, the more you make of our resources, the more you must pay. When it comes to company tax, one must be very careful to touch that, and I addressed that in a webinar, because you are taxing productivity and you're not becoming competitive with other countries in the world. So that is one of the last things that you will have to resort.
Okay.
Will there be a replay?
And then Pumi Singh is asking if there will be a replay of the webinar. No, Pumi, but it is recorded, so you can catch it. There will be comms sent out as well to our customers as to the infogram, as well as where you can catch this. For the planners, it is on the SBFC portal.
Let me take us 2 more questions.
And
can you start in a retirement annuity when you are 67? Absolutely. Why not? 67, you're still very, very young. Previously, there was a limitation many years ago that you had to retire at 69. That requirement has fallen away. So it remains an excellent vehicle still to use. Then this last question, perhaps, please elaborate on using capital gains to increase your RA deduction. I'm not sure what you understood this fully. Well, very simply, in the explanatory memorandum, there was quite a contentious issue for about 3-4 years. The definition of retirement unit deduction says you can claim the greater of 27.5% of remuneration, that's your salary, or taxable income. Now, when you calculate capital gains, it is included in taxable income. So, if you would have an income of, let's say, 200,000 for the year, and you would have a capital gain because you disposed of some unit trust, for instance, then that capital gain is added to taxable income, and when you calculate the 27.5, you calculated it against that amount, as long as your deduction overall is not higher than your remuneration. So clarity was given now recently in December, and that is the position, and that is the position of SARS as well.
Okay. Thank you so much, Errol. Ladies and gentlemen, we've run out of time, but what an insightful hour that we've had. Thank you very much for tuning in, for taking the time out to tune in. Like I said, if you're one of our customers, there will be comms sent out. Look out for that with an infogram as well. Thank you very much to the planners as well for taking the time out of your day to come and listen in. Have a good day, and we'll see you on the next webinar. Look out for communications. Goodbye.